and now we can sell that loan for $90,000 or $100,000. That's called loan renovation. So we're going to come in and clean up the note. Performing notes are considered performing when the borrower is current on all payments. A performing note has a good borrower, good collateral. These command the highest price for investors wishing to own them, often trading at or just below face value. Performing notes are typically bought by investors seeking reliable, consistent income. This includes financial institutions, investors like insurance companies, hedge funds, and private investors who buy them to add a reliable income stream to their retirement accounts. Now, any mortgage note, deed of trust, or land contract, or other debt instrument where the payments are not current, and where the payer has shown either reluctance or an inability to pay on time, is what creates what we call ugly paper, okay? The ugly paper, or the ugly note. Now, let me set the stage for you here, okay? Assume that this is a $100,000 note, okay? So you've met somebody at a cocktail party, you start talking real estate, and they go, hey, do you ever buy notes? And you say, yeah, I'm interested in notes. And they say, well, I've got a $100,000 note that I'm trying to sell. Your question is the note performing? And they say, well, it's more of a scratch and a dent type of a deal. The payments are usually within the 15-day grace period, but they're usually not on time, okay? Now, what that person just told you is the price for the $100,000 note is $96,000 to $98,000, okay? That's the percentage. However, if the payments of that loan have been sporadic, meaning 30 days will come and go and we won't get a payment for the month of January, but we'll probably get 2 payments in February or March. So they'll catch themselves up. Well, that's a note you would only pay 92 to 94 cents on. However, if they've stopped paying altogether and they're not responding to any collection efforts, you can now buy that $100,000 note for $80,000. If that $100,000 note was written at, let's call it 8% interest, and you buy it for $80,000, when you recover the $100,000, you get that $20,000 surplus, which means you're now making 11 or 12% on your $80,000 investment. Now, if they have taken to the point where it's going to foreclosure, which means the official foreclosure notice or lis pendens has been filed, the short sale period is passed, you're paying 65 cents on the dollar. So now that $100 note is worth 65 grand. And if the notice of sale, which means this thing is going to auction and the redemptive period is gone, you can get that note for $40,000. Now, I want you to think about it in these terms, okay? What if we apply the same concept to a house, right? So we've got a house and the borrower wants $100,000 for it, but it's not in the best of shape. You're not going to pay $100,000 for it. You might pay 90 cents or 80 cents or 60 cents. But what if that house is absolutely trashed? And for you to get that thing to be worth $100,000 again, you're going to have to invest some money in it. You're going to have to fix it up, clean it up, remodel it to get it back to that $100,000 value. We do the same thing with the note, okay? So we buy that note at a discount. We go back to the person who said they'd make those payments, and we modify the loan. And we get a new note. So we buy the note for $40,000. We work with the borrower. We get a new note for $100,000 or $90,000. Monthly payments begin coming in again. And now we can sell that loan for $90,000 or $100,000. That's called loan renovation. So we're going to come in and clean up the note.